Coming now to target company valuation. We have three broad categories here: discounted cash flow, comparable company analysis, and comparable transaction analysis. With the discounted cash flow method, we determine the free cash flow to firm till the terminal year, and we also estimate a terminal value, then we discount back. There are two ways of coming up with the terminal value. One is to use the Gordon growth formula. So we basically take the free cash flow in the terminal year, multiply by 1 plus the growth rate, and then divide by the weighted average cost of capital minus G. So this is how we come up with the terminal value. Another method is to apply a valuation multiple to estimate the terminal value. With the comparable company analysis, we define a set of companies that are similar to the target and calculate their relative value measures. So for example, we might say that the relevant measure is the price earnings multiple. We then determine the price at which the target company should trade. So if on average the price earnings multiple is 10, then we come up with the estimated price for our target company using this multiple and the earnings number. So based on this tip, we might come up with what the stock price should be, and then we might decide on a takeover premium. So the takeover premium would be the deal price minus the stock price divided by stock price. If the stock price should be 100 and we want to offer a 10% premium, then the deal price will be 110. With the comparable transaction analysis method, we use details from takeover transactions of comparable companies. So here again, we might study multiples such as PE or price to cash flow and other industry-specific multiples. But here the price would be the takeover price. And then based on these multiples, we determine what the takeover price should be for our target company. An important point here is that the takeover premium has already been built into these numbers. So unlike the comparable company analysis method, here we do not need to add a premium. There are advantages and disadvantages of all these methods. I would want you to read these advantages and disadvantages. I'll just go over one advantage and one disadvantage for each. So with the discounted cash flow, one advantage is that the expected change in target company's cash flows can be easily modeled, and a disadvantage is that it's difficult to apply when free cash flows do not align with profitability in the first stage. For comparable company analysis, the advantage is that this method provides a reasonable approximation of a target company's value relative to similar companies in the market. The disadvantage is that it's difficult to incorporate any specific plan for the target company. With the comparable transaction analysis method, the advantage is that it's not necessary to separately estimate takeover premiums, and the disadvantage is that there is a risk that the real takeover values in past transactions were not accurate.